What's up, team? Sean from Rest to Live here. And today we're going to talk about 3 option strategies that I am currently playing in and around Palantir, PLTR, but could really be used for any stock that you feel comfortable with and you've done your research on. First and foremost, please, I don't know your financial situation, your level of experience, what kind of capital you're sitting on in your portfolio. So please make sure you're in a good situation. You understand what you're doing, and you can properly do the right research and due diligence before executing on any kind of complex trade like an option. I just want to throw it out there. It's not normal, right? There's a lot to consider. Now let's jump in. Let's not waste any more time. First and foremost, we've been hearing a ton of good news coming out around Palantir. We've also started to see the possible slowing down of maybe a recession and even some growth coming back to stocks overall. So what we're seeing is stocks seem to have, stocks seem to have stabilized. More contracts have come through. Another almost $100 million contract has come out from the US Army for Palantir. And on top of all of these great things, we're also seeing analysts calling for an almost doubling of the price of the current share value. So up to about $20 is what some analysts are calling right now. I did a video on this a few days ago. Feel free to check that out. So what I think about as an investor is, where can I get the most bang for my buck? Or where can I take advantage of all this good news in a way that won't necessarily cost me a ton up front, but will give me a lot of value or a lot of potential value, at least in the trades that I'm executing on against a position, in this case, Palantir. Now, the nice thing about Palantir as well, from an options perspective, is it's a low price stock. So it doesn't cost as much from a premium perspective or what you pay to have those options. Now, let's call this out real quick here. We're going to talk about 3 unique option strategies. Number 1, we're going to talk about buying calls. Number 2, we're going to talk about selling puts. Number 3, we're going to talk about long dated leaps for call options. Okay. And it's important to understand the difference. So let's talk about the 3 real quick here. When you buy a call option, what you're doing is you are paying via a premium for the right to buy a stock at a certain price, no matter what has happened in the market. So if you were to buy options contracts today at a price of $10 per contract, right, at a contract value of $10 per share, you're going to pay some premium for that. But even if the price goes up to 20, when you execute on that options contract, you're only going to be paying that $10 per share. So you'll have that net benefit value in between what you paid and what they're worth today. Now, keep in mind, many people will execute before taking ownership of the stock as well, but you can still get that back in the form of selling that back to close out the option. So this is the way a lot of people play it. This is how folks like myself play it. It's important also to understand with call options that you can do them at today's price. You can do them at perceived future price. You can do them really anywhere you want in that spectrum of pricing. The only difference will be how much you pay in premium, how long you're going to look out, right? You might want to trade an inter-week deal, something that, closes every Friday. Maybe it's in a month, maybe it's 2 months or 6 or 12. That's on you to decide. And the further out you go, typically the more you're going to pay, in premium for that protection. However, the further you get from price, the more discount you're going to get as well. So there's an ebb and a flow to understanding how to play call options. But in general, let's talk about the basics. You're simply buying it based on today's price, and any positive that you gain in that price will be your profit on that trade. You're buying it at 10, you're going to close it out that future value. The second thing we want to talk about here is selling puts. And this is a really interesting one, and one that I do quite a bit myself. So the idea behind selling a put is it's very much like insurance. You're selling this contract to an investor who maybe wants to protect their downside or hedge against a position. And what you're saying to them is, for the right of the premium they pay you, you'll sell them a contract that allows them to buy the shares at an agreed upon price. So let's say you did this, sold a put contract for $9.50, but something happens and the stock crashes all the way down to $5. Well, that investor is getting out at $9.50 no matter what. That's what you owe them. You're going to be left holding those shares all the way down to $5 if you're not careful and don't hedge yourself as well. So in essence, to really simplify it, when you sell a put option, what you're doing is agreeing to buy that stock, in this case it would be Palantir, at an agreed upon price, right? So the idea is you ultimately will lose money if it falls below the strike price of the put that you sold out. So there's risk in here for everyone involved. But the nice thing about it is when you have a position that is somewhat stabilized, somewhat in a range, like we're seeing with Palantir today, you can potentially keep selling those puts on and on and on, over and over and over again, and keep collecting that premium, keep collecting that premium. Now, what's more, with more good news coming in, a softening of the crashing of the tech space, and some good analyst calls on near-term numbers, there is a degree of built-in safety from that risk perspective. So this is a good strategy for those who are trying to generate just some regular income off of a stock that's pretty well researched with a lot of news coming out about it. So just to recap, we talked first about this idea of, options, right? Buying the right to an options contract and paying premium for that, potentially take the ride all the way up with the leverage built into an option. We could sell puts in a case where we're going to collect premium for guaranteeing price or providing insurance to another person who buys that from you. Now, the last thing we want to talk about, and this is how I'm playing this, the last thing we want to talk about are LEAPs or LEAPs. These are options that have an expiration date longer or greater than a 1 year period, like a normal option might be. So LEAP stands for long-term equity anticipation securities. And it's exactly like a normal option, right? It's got the same build, the same contract value, the underlying securities, the strike prices, expiration price. It is completely and utterly the same. Just think of it in terms of, instead of a sprint, it's a marathon, and you're just investing via the marathon for that longer range. Now, a true example of what I did recently is I had been watching the price of Palantir just continuously get crushed. When it reached somewhere around the, under 10, but $8 to $10 range, I had really been selling a lot of puts, really aggressively jumping in there. And anytime that I was assigned those puts, I was happy to keep them because I do plan to hold the equity long term. But one thing really spun up to me all of a sudden. I think this is a great call that I want to explain here. There was a day where the price really dropped precipitously. And I saw the opportunity to jump in and buy LEAPs at a strike price of $7.50. Now, that price represented to me what really felt like an actual and true bottom. I've been doing this for a long time. I'm looking at things like technical analysis. I'm looking at fundamental analysis based on contracts and contract values. I'm trying to derive the actual value of this company at a bare minimum, right? And I felt that that price personally, from my level of research, represented something very, very near what would be a bottom based on what was coming up. Now, if it went down to 6 or even a 5, I wouldn't have worried about it because my vision, and the reason I use LEAPs, is I'm looking out past the current problems we're having within our macroeconomic perspective. So I had jumped into a bunch of $7.50 call options long-term as far out as I could get them. And now today with a current price of about $10.50, I'm up quite a bit already. I have no intention of selling this whatsoever, and I plan to hold it for the long term. And the value of this is if, for instance, we get to that $20 price target, as we're hearing from some analysts, that represents almost a 300% gain in price for what I paid for that underlying options at a strike level. Now, to really explain my thesis here and why I think this is a good thing to learn, I'm not saying you should go out and do this, but you should start to learn about it, is we keep hearing this messaging around being a long-term investor, holding for the long term, taking advantage of that long-term view of the world. We're coming off of a time period where stocks, in particular Palantir, have been beaten down from their all-time highs, terribly low prices. But the beauty of that is if you have the stomach and you can get into a position and you can wait a long time, you can get very large asymmetrical gains by waiting. And you can make them even larger by leveraging options because you're paying only the premium to hold 100 shares per contract. So all that additional build can be held on the long term, and you can let it work through all of the earnings, all of the contract expansions, everything that might happen. Now, of course, anything that you do over the long term has additional degrees of risk. Anything could happen in the next 2, 3, 4 years, anything. We could have another big recession. We could see companies go out of business. We could see a shift in the underlying technology that runs our world. But since I can't control all of those things, all I can do is try to find opportunities to profit with predictable risk. So in the case of a LEAP, the reason I happen to like doing this myself is I know exactly my maximum loss on that deal. That is the premium I pay to be in that LEAP. No matter what happens, this thing goes to zero, they go out of business and they're gone. All I lose is the premium that I paid up front. I never own the shares. I just own the right to own the shares. It's a really good call out. So this is one of the reasons why it really pays to get some education, start to get an understanding, start to know what to do in terms of these types of plays, these derivative options you can take. So let me wrap it up with this, right? Whether you're buying calls in the near term, you're selling puts to help other people protect their positions and profit on the premium, or you're looking long-term like me to really get a value or really look for asymmetrical returns, there's lots of ways you can play this, but these are my 3 favorites. And I just want to say this too. Make sure you do your research, make sure you understand what you're paying, but more than anything, make sure you understand the risk. And if you're not comfortable or you're not sure, stop, get out, don't do it. It makes no sense for you. So with that, thanks so much for watching. I can go deeper on any of these topics if it's requested, and I can even think about it from the perspective of other stocks, other positions. This just happens to be a really hot button one with a nice low price target, with a nice low current price as well. So it makes it feasible for a lot of smaller portfolios to be able to engage with this security and engage in what they want to do with it. But again, know yourself, know your portfolio, do your own research, and know your risk and your ability to handle risk, your risk mitigation. So with that, thanks so much, everybody. Really appreciate it. Hope you have a good rest of the day. Thanks for watching.